Hello, another month is over. We are already in May. Today is Thursday, May 6th, 2021. In this vlog, I don't actually want to purchase any additional stocks. Rather, I'm just planning on buying more shares tomorrow, and here I just want to explain why. So the purpose is just to keep track of my thought processes and justify my decisions to myself. And so if something goes wrong, then at least I know why I did what I did. And in particular, the big issue, and not just for me, but for the whole market, all the market participants are talking about this in the news, is inflation. And it's also what I said last time I would consider for my next investments. Next time, I want to think more about the relationship between interest rates and inflation and central banks. It's very confusing to me, but very important. So essentially, you can think of the current climate as a tug of war between expectations for higher inflation and tighter monetary policy. And the two are mutually exclusive. It's either one or the other.
The narrow trading range of the last 7 weeks seems to reflect a fight between inflation and growth on one side of the equation versus a world full of negative yielding sovereign debt, including a German 10-year yield trading at negative 0.25%.
So if I come out on the side of higher inflation, then I would invest in things like commodity stocks and buy more Rio Tinto. But if I come out on the side of higher interest rates, then I would try to find more value stocks like AbbVie. So let's see what my brain comes up with. The first investment thesis is that inflation will in fact be the driving force for the markets in the coming months and years. I could present a whole montage of video clips of people worried about inflation. You can see it everywhere. People talk about food, soybeans and corn prices all really high, lumber, which is driving up housing prices. Copper is in the news a lot, and everything in between. Flour prices, oil, shipping costs, microchips, everything is getting more expensive. And it's not just conspiracy theorists saying this, mainstream people are talking about this. JP Morgan and Warren Buffett and many others, they're all voicing concerns about inflation.
Rising cost of raw materials also really hitting solar stocks here. We heard that during first quarter earnings calls, this really is an issue going forward. They've seen ship costs rise 100% over the last few months, and that's expected to hit their margins going forward.
We announced a price increase in 3 categories in the United States: baby care, feminine care, and adult incontinence. So we expect to be able to carry those price increases through once they're launched in September.
On the other hand, inflation might not actually be a big problem, and that is in fact the base scenario by central banks. The idea is that inflation will just be transitory. That's the big buzzword that everybody is using, transitory inflation, and then eventually it will come down again. Or even if there is higher inflation, then central banks would fight it. They would increase interest rates or reduce their asset purchases.
During this time of reopening, we are likely to see some upward pressure on prices. And those pressures are likely to be temporary as base effects. 12-month measures of inflation are likely to move well above 2% over the next few months as the very low inflation readings recorded in March and April of last year drop out of the calculation. Significant increases, and they'll disappear over the following months. Bottlenecks. So this is what we're seeing in supply chains in various industries. And we think of bottlenecks as things that in their nature will be resolved as workers and businesses adapt. And we think of them as not calling for a change in monetary policy since they're temporary. If, contrary to expectations, inflation were to move persistently and materially above 2% in a manner that threatened to move in longer-term inflation expectations materially above 2%, we would use our tools to bring inflation and expectations down to mandate consistent levels.
So this then leads to a number of different scenarios. We could see higher inflation in the long run that is not just transient, and we would just have to learn to live with higher prices. That's sort of the mild version of this outcome. It could be even more extreme. It could be that central banks ease even further, and that would lit a fire under the inflation that we already have. So for instance, it could be that in anticipation of higher inflation, interest rates rise, and that would create all kinds of pressures on the stock market, on the housing market, and so on. And then the Fed would try to do something about it. They could put off the tapering, or they could even implement yield curve control and buy up more, say, 10-year treasuries to suppress the rates. On the other hand, it could be that inflation just goes away again, like central banks expect, and that would be the weak version of this. It could also be a stronger version, namely that inflation needs to be fought, that we need tighter policy, and that the Fed will actually implement a tighter policy. And that last scenario, that is in fact what I see a lot discussed in the news, and that's what creates this tug of war. People think here's high inflation, so obviously the Fed will do something about it. And again, I could show lots and lots of clips where this is something that you have to read in between the lines.
I was at the grocery store myself today. Americans are seeing much higher grocery bills than they had before. So the pressure is going to increase on Jay Powell as we head into these next two very nasty base effect months.
I do think bigger picture, there's a dawning realization among financial professionals, investment professionals, that the Federal Reserve is inappropriately still buying $40 billion worth of mortgage bonds every month and $80 billion worth of treasuries. So if you ask me what's up with these lackluster responses to great earnings, I think it's because people know the taper is coming sooner than what the Fed is saying.
Those two scenarios lead to very different strategies for my investments. So if there is in fact higher inflation, then I would want to invest in things like commodities or maybe agriculture, and in general I would play it more defensively and take risk off. But if central banks keep everything under control, and if conditions stay easy or interest rates rise slightly, then financials might be a good idea. And also you could invest in growth stocks, and you could just generally play it more aggressively and take on some risk. So you can see those two strategies are not really compatible. It makes no sense to do both. So you need to make a decision. You have to decide what you think is more likely to happen and then structure your investments accordingly. So I've thought about this long and hard, and I think I am going to go with outcome A. I think inflation will ultimately be a problem. So why is that? Well, first of all, thinking it through, I just don't really see how central banks could effectively tighten monetary policy effectively in the near to medium term. Firstly, you have all these debts and deficits. They need to be financed, and you can only finance them if interest rates remain low. So President Biden just came out and announced his third stimulus package.
American Families Plan. There's a lot in here. These have been some Democratic wish list items for a long time, but I think some of the headline programs, Biden wants to make universal pre-kindergarten available to all 3- and 4-year-olds. He wants to offer child care assistance. There's 2 years of free community college. There's a long list of stuff in here, and this is the third of Biden's big plans. All told, he wants to do $6 trillion in new spending. I mean, it's just a huge set of programs.
It's true that this spending will be stretched out over several years, and that there are also tax increases to pay for some of this spending, but I just don't think it's enough. I think the only way to really finance all of these infrastructure programs is if you continue to support the debt market and buy, financial instruments like treasury bonds. Then another reason is, what would happen to the stock market or to markets in general? Just a few days ago, Janet Yellen sort of accidentally said that interest rates might have to go up, and markets did not like it. They actually sold off quite a bit, and that's just from saying that perhaps there might be a slight increase. What would happen if interest rates actually went up? Well, markets would drop quite a lot.
It may be that interest rates will have to rise somewhat to make sure that our economy doesn't overheat, even though the additional spending is relatively small relative to the size of the economy. So it could cause some very modest increases in interest rates to get that reallocation.
That was Treasury Secretary Janet Yellen speaking earlier today, and those comments rattled investors.
And of course, the Fed is already saying that they're going to move very slowly. They're going to take a lot of time. I think at the moment, the consensus is that tapering will begin early next year in 2022, and then interest rates are set to rise beginning in 2023. So that's a lot of time for inflation to increase and become more entrenched in the economy.
June or July, the Fed will publicly tell us it's discussing tapering, perhaps. September, October, the Fed would announce that it's going to taper. And in January, there's a lot of consensus around this, the Fed would actually begin to reduce its $120 billion in asset purchases. And that right now is how markets are betting.
We'll have some notification of the tapering by June and hikes in March 2023. That's the market consensus.
And also, I think it's strange how defiantly the Fed is talking about raising interest rates. It's almost as if they're offended that the markets wouldn't believe them when they say they can raise interest rates. So it sounds a bit like a bluff, as if they know that it's going to be very difficult to actually pull this off.
You know, I'll just sum up and say, we understand our job, we will do our job. If we see inflation moving materially above 2% in a persistent way that risks inflation expectations drifting up, then we will use our tools to guide inflation and expectations back down to 2%. No one should doubt that we will do that.
So then there is this hope that inflation might just be transitory and go away again. And I actually hope that's true, because nobody needs higher food prices and the social unrest that's usually associated with it and stuff like this. So I actually hope that central banks are right and that inflation is just temporary. But unfortunately, I also think there's a good chance that it is not, because there are going to be strong political pressures to keep the stimulus going. And also the workforce might actually be shrinking. People might be dropping out from the labor force. And there's just so much cash and credit sloshing around. It's burning holes in people's pockets. And so I think they're just going to go out and spend their savings.
You don't think these inflation pressures will prove passing. Can you explain why? I mean,
well, we are in a situation where we're likely to have continued fiscal stimulus. It's quite unlikely that in an election year, the Congress is going to let their constituents have less money next year than they had in 2021.
You know, we're coming out of a crisis where both banks have capacity to lend and households have great capacity to spend and to borrow.
Okay, so there you have it. I want to bet big on higher inflation as the most likely outcome of the current situation. And I even think it's possible that central banks will not only not tighten, but ease further. For instance, there could be another natural disaster, a hurricane, or the virus could come back with another variant, or there could be political tensions like Russia building up an army near Ukraine or stuff like this. And then investors might think, well, how is the US going to finance all of this on top of everything else? And then inflation could spike even more. I'm not saying that's likely, but I do think it's possible. So that's where I see this big opportunity, because the markets are not really prepared for this outcome. Rather, they're sitting on the fence. They're waiting. They're trying to see what's going to happen. And every time interest rates go up a little bit, investors get all fearful and jittery and there's a sell-off. So I think once it dawns on them that inflation is going to be here to stay, that's when these inflation-sensitive stocks can really take off. Then, of course, on the other hand, if not, then all the gains we've made in the commodities could reverse and, those prices could come down again. So this is very risky. This is not chiseled in stone, but this is going to be my scenario, the working hypothesis that I'm going to use for my investments. All right, so here is my plan. I want to buy a bunch of precious metal and commodity stocks. I know it's not very cool, it's a bit boring, it's frowned upon, it's a bit conspiratorial, but I do think this is a really good opportunity. The gold stocks haven't really rallied like many of the other commodities. Unlike copper, they haven't really hit their high yet, so I think they're still quite cheap. The problem is timing. So the market has no clarity. They're still very much on the fence. Every time interest rates go up, these kinds of stocks sell off hard. So it's not clear when I should buy these. It's the right moment is quite difficult to find. In fact, I should probably have bought them yesterday when I had this idea. Maybe other investors have thoughts along these lines as well, because today gold stocks were actually up sharply. Gold for the first time in many weeks above 1800, and some of these stocks up 4, 5, 6%. So it would have been good if I had already bought them, then I would be up now and feel a bit better about this idea. But you can't change the past, so instead this is my plan now. Tomorrow we're going to get the jobs report for April, and I'm expecting this to be an extremely good report, maybe 1 million jobs or something like this. So euphoria, everybody is happy about this really great report. The result, though, paradoxically, would be that this good news should be bad news, because we're one step closer to tighter monetary policy, to increased interest rates. So interest rates should go up, and that usually leads to a sell-off in the markets, especially in gold stocks. And since we had this big rally today, it's also quite common that usually the next day you have a bit of a drop or some profit taking. So then I hope after this jobs report comes out, I can buy these stocks and actually pile in with what is for me quite a lot of money. So yeah, that's my plan for tomorrow. Okay, so this is basically all I wanted to say today. In this vlog, I have developed an investment thesis in terms of inflation, interest rates, central banks, debt and deficits, and so on, like I had wanted to do. And I have made a decision on where I stand on the inflation debate, namely that I am quite pessimistic and that I do think that inflation might be a problem in the future. Maybe I'm wrong. In fact, there's a part of me that hopes that I'm wrong. Nobody really needs inflation. But, you know, everybody is entitled to an opinion, and this is how I am going to approach the stock market for the foreseeable future. So tomorrow I have a big important day because I will try to buy some precious metal stocks, hopefully on the cheap. And so I'm excited to see how the jobs report will pan out. And then I will make another video to continue the documentation of my little stock market adventure.